Bitcoin Doesn't Care, Part 1. Yo everyone, welcome back to the channel. Today, we're kicking off a series on why Bitcoin just doesn't care about anything. In Part 1, we're diving into its financial and investment independence. Bitcoin isn't fazed by markets, regulations, or your trading mistakes. It's built to last. If you're new to crypto, stick around. This will change how you see BTC. Hit like and subscribe for more. Bitcoin doesn't care about regulation. Bitcoin operates on a peer-to-peer network without needing approval from regulators, making it censorship-resistant. This means it can thrive in environments where traditional finance is heavily controlled. Think about it. How does blockchain ensure global accessibility? It educates us on true financial freedom. Bitcoin doesn't care about being institutionalized. Unlike stocks or bonds that rely on banks and institutions, Bitcoin is designed to be trustless. Users control their own assets via private keys. This teaches the importance of self-custody and why Bitcoin challenges centralized finance. Have you ever wondered why we need banks anyway? Bitcoin doesn't care that you think it is an investment. Bitcoin isn't bound by conventional investment metrics. It's often seen as digital gold due to its fixed supply of 21 million coins. This explanation helps you understand its role as a hedge against inflation, rather than just a speculative stock. Pretty cool, right? Bitcoin doesn't care that you do not think it is an investment. Even if you view it as just a technology or currency, Bitcoin's value comes from its utility in borderless transactions. This adds educational value by discussing real-world use cases, like remittances in developing economies. Imagine sending money home without fees eating it up. Bitcoin doesn't care that you can't build a DCF around it. Discounted cash flow, or DCF, models don't apply because Bitcoin generates no cash flows. Its worth is driven by network effects and adoption. Viewers, you'll learn about alternative valuation methods, like stock-to-flow models. It's a whole new way to think about value. Bitcoin doesn't care that it doesn't yield anything. Without dividends or interest, Bitcoin's appeal lies in potential appreciation from scarcity. This educates on how halving events reduce new supply, historically leading to price increases. Ever heard of the halving? It's like Bitcoin's built-in scarcity timer. Bitcoin doesn't care about integrating with the current system. Bitcoin was created to bypass legacy financial systems, enabling direct peer-to-peer electronic cash. This insight explains its disruptive potential, like enabling micropayments without intermediaries. Why stick with the old ways when you can go direct? Bitcoin doesn't care about the dollar price you pay for it. Price volatility doesn't affect Bitcoin's underlying protocol. It's about long-term holding, or HODLing. This teaches risk management and the difference between short-term trading versus strategic accumulation. Patience pays off, folks. Bitcoin doesn't care that you bought or sold the top. Market timing is irrelevant to Bitcoin's fixed issuance schedule. Historical data shows recoveries after peaks, emphasizing patience in crypto investing. Remember those big drops? They always bounce back. Bitcoin doesn't care that you bought or sold the dip. Dips are opportunities, but Bitcoin's code runs regardless. This adds value by discussing dollar-cost averaging as a strategy to mitigate volatility. It's simple. Buy regularly and let time do the work. Bitcoin doesn't care that you let an exchange custody for you, or anyone for that matter. Exchanges can fail, like Mt. Gox did. So, self-custody via wallets is key. This educates on security best practices, like using hardware wallets. Don't let someone else hold your keys. Bitcoin doesn't care that you didn't know what a private key was and lost all your Bitcoin. Lost keys mean permanent loss. Bitcoin enforces responsibility. Viewers, learn about seed phrases and why education on wallets is crucial. One mistake and poof, it's gone forever. Bitcoin doesn't care that its dollar price is down 5 months in a row. Bear markets are part of cycles. Bitcoin has survived multiple crashes. This provides historical context, like the 2018 to 2020 recovery. Hang in there, history repeats. Bitcoin doesn't care when its dollar price is up 5 months in a row. Bull runs don't change the protocol, they're driven by adoption. Factors like institutional entry, such as ETFs, fuel growth. See how big players are jumping in. Bitcoin doesn't care that its dollar price is not stable. Stability isn't the goal. Bitcoin is volatile but offers uncensorable value transfer. This compares it to stablecoins for contrast. Volatility is the price of freedom. Bitcoin doesn't care who decides to stupidly speculate over short periods of time on it. Short-term speculation often leads to losses, but Bitcoin rewards long-term holders. This teaches behavioral finance in crypto. Don't chase the hype, think long game. Bitcoin doesn't care that you want to sell it back into fiat. You can convert anytime, but Bitcoin aims to reduce fiat dependency. Growing merchant adoption makes holding viable. More stores accepting BTC every day. That's part 1. Bitcoin's financial freedom in a nutshell. What do you think? Drop a comment. Does Bitcoin care about your portfolio? Stay tuned for part 2 on political independence. Like, subscribe, and hit the bell. Thanks for watching. See you next time.